Let's have a look at this. Now, this was the trade plan, or this was crude oil, and I'll try and widen this out a little bit. There we go. That was crude oil. That was my testing on crude for the cycle trader. Now, I was thinking that now this ties in with Karen's testing, so I'm going to just show you how it ties in. But let's have a look here. So this was the cycle trader on the 450 tick, and you can see there that when I initially tested this, I was thinking, oh, this is fantastic. I found a really good time slot for the cycle trader, like 12 to 1400, and looking really good, solid results. And most people would do this. Most people who either looking at systems or strategies, you'll look at the equity graph, as everybody does. Have a look at its worst drawdown, have a look at its average net profit on each trade, and then you'll start to work out exactly what the potential of this particular strategy is. Now, what happened with this thing is that I continue to track this because I know that crude oil is a shifting market, and it will shift constantly in relation to its volatility and what's happening during the session and where the moves are coming. And what happened with this is that this cycle trader, which buys support, sells resistance, it was working really well for the first couple of months, and then it just went. The actual market conditions changed, and it had a $2,000 drawdown there. Then it bounced back up a little bit, went back. So then it kind of got a bit sideways. I wasn't too worried about it because I knew that, I thought, well, the actual market should be okay in relation to that cycle activity because it's lunch hour. You're expecting that there's not going to be a lot of breakout trading during the lunch hour, and continued on, and then it just went and just capitulated. So this is why it's important. This is why we have to monitor our strategies, and this is why a multi-system strategy is so powerful. Because if I put the trend trader onto this, which I will do for our next update, I'll show you the trend trader versus this. You'll see that from about the 100th trade 100, the trend trader will start to kick into gear and really take off. But the cycle trader hasn't liked the market conditions. So this is why it's critical that we're on top of this and we make sure. Now, how do we avoid? I mean, obviously, most people when they trade, they'll start with, say, a 10 or a 20k account, and they'll decide that, all right, I'm going to start with a 20k account, and I'm going to, by the way, this is the only strategy that I've tested that has had this much of a dramatic drop. So all of the other strategies which I'm going to go through tonight have been consistently, either flat or increasing in equity. This is the only one from 12 to 1400 on the cycle that has been such a dramatic change in its market dynamic. But it can happen to any market, any strategy at any time. So you've got to be ready and have a contingency plan for that as a trader, because if you don't have that, then you're sitting here and you're just watching it. And the worst thing that you can do is say, right, well, I'm going to have a max drawdown, and we'll move over here for a second. My maximum drawdown is going to be on my account 20%. Well, most people when they say that, they say 20% on my initial capital. So if your initial capital is 10 grand, then you're going to allow $2,000 to be wiped off the account, and then you'll stop trading or review the process. If it's you'll allow 40% drawdown, then obviously $4,000. But what we don't want is we don't want to accumulate this profit here. So we've accumulated this profit here, and then we don't want to then decide that, right, well, I'll keep trading this system because I know it's going to turn around. But if it drops down below 40% of my capital, then I'm done. That's way too much time and money to to give back to the market. So what you've got to do is you've definitely got to have a plan for. You've got to have a circuit breaker exactly the same as when we're trading during our day trading or our swing trading session. And you might have, say, 2 losers. If you have a third loser, you're done. Or if you have 1 loser, or if you have two losers that equal your maximum dollar drawdown, then you stop trading. Well, we need to have the same thing with our system. Our system needs a circuit breaker. Otherwise, if you don't have that, then you're going to really struggle to make a decision. Because remember that each part of our trading process, whether it's going into the market and trading, whether it's doing our back testing, we need to have a plan or a contingency for what needs to happen next. So if we haven't planned in advance for this contingency, then you're just going to accept what you've potentially decided previously with your generic assessment of the market and your money management, which is the general percentage drawdown. And most people do. How many people here who haven't been through, or who have been through the money management program, or who haven't, it doesn't matter, would have previously had a percentage risk drawdown, or still do have a percent risk drawdown on their capital, like most people do? I know probably most of the traders I talk to before they do the money management program, they have a maximum drawdown that they're going to have as part of their trading. But what I want to introduce to the group and as part of the live results, or the part of the results, updating results, is for us to be tracking the performance of these systems to make sure that we've got something that's a little bit more dynamic. So let's have a look at Karen's. Now I've put in here that now this is Karen's with Karen's permission, or this is Karen's kind of money management breakdown. Super job on that. Now we've got, as we spoke about before, we've got our R multiple. So 12 is our initial risk on all of the trades that we take. But what we want to do is we want to be able to at least have something that tells us when this system is not running as well as it is. Now you can play around with what we've had a look at, and we did this with the first group that went through the money management. But we did it more with, we basically did it more with, sorry, I just lost my train of thought there for a sec. We did it more with the multiple contracts. So as we traded and started to increase our contract size using the fixed ratio, so as we increased our profit, then we would add a contract, we increase our profit, and you can see the fixed ratio amount here. This is looking at a delta of $2,500, so a value of $2,500, and there's a formula for our rate of increase. So once our balance goes to 12,500, we're going to increase to 2 contracts at 17.5, 3 at 25, 4 at 35. So you kind of get the hang of that. So, but what happens? So what normally happens is, if we drop below that dollar value, we just drop our contracts. So instead of being, if we're trading with $35,000 worth of equity or profit and capital, and then suddenly we get a couple of losers. If we get below 35, well, we drop down to 4. If we get below 25, we take it down to 3, and so on and so forth. Now, what we wanted to do was, as part of the testing we've done in the money management, we decided that, or we felt that, based on 2 of the markets we tested, DAX and crude, that drawdown took, or that reduction in contracts took way too long. And what you'll find as well is, if you haven't increased your contract size, what do? When do you stop trading? At what point do you stop? So this is a point we wanted to make. So what I've done is I've actually just set up a spreadsheet here, very basic, just looking at the 3R, what we call handbrake, and the 4R handbrake. So when we get 3 times our risk, which is 12 points, is our 1R. if we get 3 times that, then a 3R drawdown, then we basically stop trading. And you can see where I've just marked in where that occurs on this spreadsheet. So as we go through, we're trading, and then we start getting some losing trades, and we hit what we call a 3R. So we've got a series of losers here, and then suddenly, oh, it's actually here, that's our kind of bad run of losers. So we would apply a handbrake. Now if we're only on one contract, that may be that we just apply then, instead of reducing our contracts, we just stop trading until that gets back to under that 3R multiple. So we need to make sure that if you're going to use this strategy, you're either using a 3 or 4 or whatever you decide, that as soon as you get back under that 3, then your trading continues again. And because the systems, what you're getting is you're getting a system that's kind of performing as it should do, rather than going into drawdown. So you can imagine that once I enter this data here on our crude chart, we're going to see that would have been trading this area here, but once we hit this drawdown, we're going to have saved ourselves a lot of money, because all of this period here was in significant drawdown. So we wouldn't have been trading that, and that would have saved us a lot of potential pain as the market started to change its dynamic in relation to the cycle. Yeah, absolutely. Brian makes a good point there. What I did, Brian, was I never really over-optimize strategies. I basically run them, and then they run for 6 months, and I don't kind of continue to change the stops and that. But you definitely need to, if the dynamics of the market change, so that if the market becomes more volatile, and your system is getting, like you've said there, if your system's getting knocked out by, say, 5 or 10 points because the range has increased or decreased, then you need to be able to address that with your system. So that's where the back testing and going through the strategy, like Karen's done here, and having a really good idea of kind of how your system's performing. If you start to see a pattern develop over the stop structure, and you decide that you need to increase that stop, and that's going to allow you to have more winning trades, I mean it will potentially increase your risk, but you will find that you potentially will find that your results will improve. But getting back to the R multiple there, so you can see that this is one way for us to stay out of the market when our system is underperforming. And as soon as it hits that 3R again, so once it hits that, we stop trading. So we would have stopped trading there through that period there, and then once that gets back below 3R, which is here, and we have that 62-point winner, and then we're back into the game, then we're back trading and into it, and then we have. So what you'll find, what will happen? I haven't done it for all of them, but yeah, you're right. They're just there, 51 and 52. So that was just kind of a bit of an example. But what you will find is that using this approach, you will actually take on less. You won't have as much profit potentially in systems that are performing well over time. But what it will prevent you, what it will avoid, is being caught up in this kind of downward spiral of an equity drawdown. So it's whether you're happy to take a little bit less profit but avoid this drawdown, or you're happy to now there's 2 ways you can look at it. There's probably about 3 actually, but one is the way to avoid that kind of drawdown is to be tracking it, making sure that you're keeping an eye on the market conditions, and also running another strategy with that, like I said, the trend trader. As you see that market underperforming, you can potentially switch to another strategy. Otherwise, basically you just use the R multiple as your handbrake. So that's they're the 2 kind of ways in which you can protect yourself from that kind of a drawdown. So any questions on that before we move on to to the next part of the presentation. Any questions there? Anything? Anybody want to add anything to that?